Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby. It is Monday morning before the market opens. It is September 26th. Thank you so much for joining me on The Talking Point. I appreciate it so much. Well, I'm going to go over some things from last week, but before I get to that, I want to talk about this week just for a minute. The market is always looking after the kind of sell-off that we saw last week for a bounce, right? You'll hear that over and over again. And of course, the hope is that a bounce leads to the real thing, right? That, we're getting out of the bear market. We're finished with the bear market. Well, if only. But the fact of the matter is, that's the way it starts. It typically starts with short covering, because as the market climbs, those who bet against the market, in essence shorted the market, have to cover it. So they have to go and they have to buy it and they have to cover it, and that helps push the market higher. That's the stage. That's the stage for the quote unquote real thing, that when we get out. But it also happens when it is just what we would call a bear market bounce. Because what you need to see, obviously, is continued buying, heavy volume to show that there is confidence. And then, we go back to looking for the 50-day moving average of the meaning that 90% of the stocks of the S&P 500 cross their 50-day moving average, and then you get to the next one, which is that they cross their 200-day moving average. So it's a process. And along with that, one of the other things that we look for is the kinds of sectors that start getting interest. And I've always stressed, you want consumer discretionary, because that tells you that the market would be thinking, well, the Fed isn't going to continue with these rate hikes. They're going to start leveling off, and more of that animal spirits. That's what we call it. That the market thinks, hey, this is it. We're headed into greener pastures. Quite frankly, the way the market looks right now, it looks as if the market is on alert for something possibly to break. Now, I want to go over that from last week and go over some of the things that had the market very worried. One was Chairman Powell. Yeah, normally when we have the press conference and on Fed Day, the market trades up. Right. I mean, it actually was statistical. I think I mentioned that in my call last Monday. This time it didn't. What happened? Because that broke a pattern, by the way, that the market sold off on Fed Day. It was that he was remarkably clear in his approach when he spoke at the press conference. It was, I'm raising rates, and we're going to do it until we've conquered inflation. And in essence, he echoed what he said at Jackson Hole. There was no opportunity for the market or the algorithms that come in first, that's the high frequency trading, to pick up anything that sounded soft or dovish. No, it was very clear. We are going to be doing this, and we're going to do it until it is finished. We're going to get rid of inflation. He also, I want to point this out, has been mentioning Paul Volcker many times. You notice at Jackson Hole, Wyoming, he mentioned Paul Volcker, he mentioned Alan Greenspan, but he did not name the head of the Federal Reserve who got us into, that stagflationary environment, and that was Arthur Burns. He came in, and what he did was he paused, he waited, then raised rates again, then he paused and he waited. And that style has been seen as just not conducive to fighting inflation. That, in fact, what it did, it made the job much more difficult because then Volcker had to fight stagflation. So in any event, he's been mentioning Paul Volcker. And what I think is going on quite simply is that the Fed and Jerome Powell, the head of the Fed, They do not want to go down in the history books as not finishing the job and leaving the Fed with more inflation. That's what it seems like. This is their legacy, and they want to get it done. Also, I do want to point out that if you notice, he will say, we're going to keep going. We're going to keep at it. You notice he has said that a number of times. Here's something interesting. Paul Volcker, for those who don't know who Paul Volcker was, he passed away actually fairly recently. But he was the Fed chairman, the end of the 70s, early 80s, who really beat inflation down, but it took a toll on the economy. He pushed rates up to actually nearly 20%, yes, and on top of that, there was unemployment reached 11% at one point. But he was concerned that if he didn't do it, if he didn't get at it just at the root cause, that we would always have this reservoir of inflation somewhere, and it would always get worse and worse. So he was determined to get it out of the system. And this is why I mentioned that Powell uses the term, we're going to keep at it, is that in 2018, Volcker, again, recently passed away, but in 2018 he wrote a book, and the book was published in October of 2018, and it was Keeping at It, right? So there you go. I think that Powell's been reading it over and over again because he's using that term. In any case, it scared the daylights out of the markets. In addition to that, it pushed the U.S. dollar even higher. And this is why that is important. A stronger dollar, which you could argue is good. A strong dollar is good. But when it gets to these extremes, it tightens financial conditions. That's why. It tightens financial conditions. And when you have a much weaker dollar, right, it eases financial conditions, not just in the U.S., but actually around the world, emerging markets, other countries. And by the way, the S&P 500, because between 30 and 40% of their earnings comes from outside the U.S. And so, if you're going in there and competing for business, especially in a global environment where, everyone is worried about a recession, where demand comes down, a weaker dollar helps you in terms of competition. So that's the issue. The other part of the story is you have countries, and again, many of them are in emerging markets, and I do want to point out many emerging markets are in very good shape. They learned from 1998, where there was a major problem in emerging markets. They learned. They've got strong current accounts. But, many still have dollar-denominated debt, both corporate and sovereign, and when the dollar rises like this, it actually, makes it much more expensive to service the debt. In addition, imports are more expensive, those priced in dollars, oil, food. And then conversely, many of these emerging markets are exporters. Well, one, you've got a slowing global environment, and many of their exports are in commodities, and that's expensive because they're all priced in dollars. So you could see the difficulty that you have. So what did we see last week that was worrisome? One, British pound sterling falling. Today, it's fallen to, I think, the lowest level ever against the U.S. dollar. It is a ramification of the dollar rising and rising against the currencies that we trade against, but also in Great Britain, you've got a new prime minister. She is determined to not just have inflation leave, because the Bank of England is determined to get rid of inflation, but she is also determined at the same time to introduce stimulus measures, major tax cuts, major benefits for those who are going to be hit with much higher energy costs over the winter. So the problem there is that the Bank of England is worried because this is only going to feed inflation. It's going to make their job much higher. And so there's a lack of confidence right now. And when there's a lack of confidence, your currency has a tendency to weaken. And a lack of certainty, your currency tends to weaken. So that's over there. Then over in Japan, let's remember, Japan is the world's third largest economy, and they are major buyers of U.S. treasuries, which you want to see them continue to be buying U.S. treasuries, correct? Because the more buyers we have, the more the yield, the price comes down, the yield comes down. So in any event, what did they do last week? Well, the finance ministry went in and did an intervention on the yen because the yen has been falling. And because it's been falling, it has been a veritable buffet for hedge funds and speculators coming in and betting that it's going to fall even more. And at some point, if you continue that, you could see where you could get a link in the global currency chain broken. So what the Treasury Department there, or the Ministry of Finance is called, went in and intervened in the market. Now, it helped just a little. And today, the yen actually weakened again. And the reason for that, by the way, is that they don't have help from the Bank of Japan, their central bank. Because what you need, just as you see here in the U.S., the more Powell becomes assertive, the more the dollar rises. The more he raises rates aggressively, the more the dollar rises. Well, in Japan, the Bank of Japan is not prepared to come out with that kind of rhetoric. They are not prepared to telegraph to the market that they are going to raise rates. And we have to remember something. Japan has lived with deflation for decades now, and they have been trying to introduce inflation where prices rise, where folks say, hey, you know what, let's buy this today because tomorrow it may be more expensive. That not hyperinflation, but just a sense of prices going higher and wages going higher. The only way Japan was able to get wages higher was to actually give the companies a break to raise wages. So in any event, you've got this tug of war between a falling yen and a central bank that says, well, we're not ready to start, raising rates. We're happy to have some inflation kicking in. That this is what we've wanted. In any event, that's one area in the overall chain of things where you've got an issue with the yen. In China, which is the world's second largest economy, their currency is also weak. But you also have the ability of the Chinese government to come in and push money into that market if they feel that the yuan or renminbi can fall further and cause damage for China. So you've got that, but the rest of the world has been raising rates, but none has been as hawkish as the rhetoric from the Federal Reserve and also the rate hike campaign. So what's happened here is that the rates are going up. Take a look at the 2-year. I mentioned the 2-year last week because the 2-year is most closely associated with Fed policy. And the 2-year is actually in the wider realm of the Treasury market looking at and saying, hey, this Fed means what it says. It's going to push rates higher. The 10-year also climbing higher. Also, what climbed higher last week, at the end of the week, was the VIX, the VIX, which has been fairly dormant. It stayed around, above 20, went to 26, but it went above 30. And why would it suddenly move that way? Because what the market is seeing and the concern that they're seeing is this tightening and spreading, the stronger dollar around the world. Also, the S&P 500, nearly 40% of their earnings come from overseas. And the stronger dollar, it does hurt. It's a headwind. It's a major headwind for the big exporting names. And many of the deals overseas, right, outside of the U.S., priced in dollars. The transactions are dollar, U.S. dollar generated. That the concern is that something can go haywire. That's the only term I want to use, goes haywire. And suddenly, that's the term that we use. We say something may break. So in other words, somewhere along the chain, and it may be via the currency market, that's why I'm stressing this, that something can break. Something goes haywire and it leads to liquidity drying up and so on. So that's why the concern and why we saw the VIX climbing. People have said, well, how come the VIX doesn't move higher, like to 70 or 80, kind of what we saw in 2007, 2008, 2009, actually. And the reason is that initially, at least, we know why things were happening. It was the Fed raising rates. But now a new element has been added, and that is the expectations from the Treasury market that the Fed is going higher, higher, and higher, and tightening as it goes. So that climb in the VIX was suggestive of a market that is becoming increasingly concerned. I want to point that out. Now, what could change it? So what can change it this week? Let's look at it. What could come out and change the dollar and just even weaken the dollar a bit? Well, what about if we see the PCE, and that's the Personal Consumption Expenditures Index? That is the version of the CPI, Consumer Price Index, that the Fed likes to look at. And that's coming out this week. And it's going to be important because it's coming out on Friday. If it is much lower, meaning cooler than the CPI was, that could certainly help. Because again, what it would suggest is that the Fed's war on inflation is taking hold. So that's a catalyst, for the market to ease. And it would be global markets easing if the U.S. dollar were to pull back under those conditions. Also this week, we are going to have a parade of Fed speakers, one after another. Even Powell is involved in a discussion, but it's on, I think, the digital market. But there are enough Fed speakers to, for the market to go one way or another. But I always just look at what am I hearing from Powell. That's the most important thing to me. And so what we see in terms of Fed speakers this week is a broad range from the dovish to the more hawkish of the Fed speakers. Typically, though, after a Fed meeting, they tend to speak in unison, coming out with the same message so that they don't confuse the market. This week, too, and I'm going to pay very close attention to this, and that is the durable goods orders, because embedded in the durable goods orders is the core capital goods orders, and that is a look at what companies are spending on capital, on equipment, right? And this is important because if we see companies continuing to spend, it's a signal that they feel good about their own budgets and that they're prepared to spend. So we'll be watching that, as will the market be watching that, and we'll have actually a raft of more housing related data. So overall, this is a market that is watching. We broke important levels in the market. Everyone knows that we broke down from 3,900. We came down. The question really is, does the market break through? Yes, the lows. And I look at that. I don't like the composition of the low, right? I look at it as 3,666. That was the intraday. But in any event, do we break through that? Or do we touch it? Do we hold it? It's going to be important. Also, any news from companies this week, any news where they come up and they have an announcement, a pre-earnings announcement, either negative, which would not be great, or how about positive, a pre-announcement. In other words, before they actually have their earnings call. That would certainly help to have a positive guidance from companies. So we're going to be on the lookout for that this week to see if we have any of those announcements. But overall, it's a market that is nervous. It's a market that's being careful. And it's a market that, does believe that we could have a bounce. But the questions you'll hear in the media on and on and on is this the real thing, or is this just another oversold bounce? Whatever it is, we want to be careful and cautious as we get through this week. And again, I want to pay attention to that PCE report. Extremely important, especially now. If it's cooler, then, the CPI, which had inflation embedded in it, broadening, the market is going to be, I think, very pleased with that, because it will indicate that, as many actually believe, that inflation is in fact coming down and moving more quickly than the headlines would suggest. Have a very good week. I'm sorry for this long call, but boy, it was some week last week. We hope that this week is a bit easier. Take good care, and please don't hesitate to get in touch. Thank you. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.